Okay, so ostensibly you've taken a look at our first weighted average cost of capital video, micro lesson 10.1, and so this is going to be the second one, micro lecture 10.2 on the weighted average cost of capital. And a very short summary, we have a capital structure. We have a capital structure of, say, 75% equity and 25% debt, and we use that to put together our WACC, right? So this is going to be something like 0.75 times our rate of equity plus 0.25 times our rate of debt, and that's how we figure out the WACC. All right, so this part is going to be a combination of sorts because while the rate of debt is relatively easy to calculate, it is whatever the bank charges you, remember the big bad evil bank, or whatever your rate is from your bonds. The rate of equity is a little harder to justify because you got to figure out what it is that your investors want, right? This guy has money, he wants to buy stocks, and he says, you need to give me an 8% return. Well, how do we know how to get the 8% return or the 18% return? And here's where we can back up the boat just a little bit to our CAPM equation. Our CAPM equation, let's use a different color here. Our CAPM equation is actually really, really awesome. It's really cool. It is the expected return, whoops, the expected, a little too far, the expected return of an investor if they were to purchase the stock. It is calculated by beta of the stock, return of the stock, times the expected return of the market minus the risk-free rate plus the risk-free rate. And this tells us what this guy is expecting. What will the investor get if they invest into the stock market? As such, this is the investor's expectation for their return. And if I have, a capital structure that has equity and debt, and I'm asking myself, well, what is the requirement from the investor? And the investor says, hey, look, I'm willing to invest in your, that looks really like a snide, hey, I'm going to make money here kind of face right there. Then the investor's going to say, well, I've used the CAPM equation to figure out what my expected return is. Therefore, your expectation should be at least this expected return of this guy. So where do we get the rate of return for the WACC? Let me put it down here. If I were to do the WACC again and say equity, percentage of equity times the rate of equity plus the percentage of my debt times the rate of debt, where do I get this rate? I get it from here, which means I get it from here. The CAPM equation gives us the expected return of the investor, which is the required return of equity for our WACC. That's where we get it from. So let's run through a problem real quick, and I promise I won't use a lot of red. So let's run through a problem real quick. Let's pretend that we have a capital structure of 75% equity and a 25% debt. Okay, so my WACC should look something like 0.75 times the rate of equity plus 0.25 times the rate of debt. Well, I can tell you that the bond rate is equal to 8%, so I can just plug that one in there, but I can't necessarily tell you what my rate of equity is. So we go out to Finance Yahoo or Google Yahoo, Google Yahoo, or Google Finance or whatever you want, and you look up, say, Apple's beta. Apple's beta, Apple down here, is equal to, at least today, 1.31 more or less. Okay, and I'm going to estimate that the annual return of, say, the S&P 500 or some other measurement for CAP is 12%, and I'm going to estimate that the risk-free rate is equal to 1%. Just estimations. You can pull them out. We can do whatever. We can do whatever we want with them. And I then turn around and say, well, the one that let me rewrite the WACC. Right? Let me rewrite the WACC real quick. My WACC equation is now 0.75, 75% equity. I still don't know what my rate of equity is, plus 0.25 or 25% rate of debt. What's my bond rate? 8%, so that one goes in there. That means I put the 8 in there, and I keep going. Well, here is, how do I calculate this out? Let's go back to yellow. So my CAPM is going to be the expected return, right, which is going to get plugged into my expectations, is equal to beta of Apple, or whatever, times the expected return of the market minus the risk-free rate plus the risk-free rate, which means that this is nothing more than plugging numbers in. 1.31, 1.31, open parentheses, 12, here's my 12%, it's the return of the market, minus 1%, is my risk-free rate, minus 1, and all of that plus 1. So let's do some really simple math here. 1.31 times 11 equals 14.41 plus 1 equals, is that right? That seems a little steep. 1.31 times 11, 1.41, 14.1, yep. So this gives me 15.41%. This is my expected return if I invest into this particular stock. And what do I do with my invested return? I plug it into my required equity. So let's rewrite the WACC equation down here at the bottom. WACC, my weighted average cost of capital is 0.75 times 15.41 plus 25% debt at 8%. And at this point, it's just mathematics. So here I have 0.75 times 15.41, 11.56 plus, this is just the number 2, right? 25% of 8 is 2. So my WACC is 13.56%. What this means is if I have the 75 and 25% structures and I want to turn around and figure out what my my project space are, then I say I have a project A and it has a $250 million investment like we've done in the past. Am I out of space here? What's going on? There we go. 1, 2, 3, 4. And you're making, yeah, I don't know, 30, 60, 125, whatever over the course of the project, then I am going to use 13.56 as my discount rate to evaluate the project if I'm figuring net present value. Do not confuse, where's my red? Note very carefully that this 15.41 is my expected rate of return for equity holders, not the entire WACC. The entire WACC is this guy, 13.56. This guy, the WACC, is what I'm going to use for calculating discount rate. Which brings up one really good question you might see on an exam. When would the expected return from CAPM be used as the discount rate? And the answer is when you have a 100% equity or all equity firm. And this makes a lot of sense. Let's do it real quick. The WACC is equal to equity over equity plus delta, or percent equity, that's all that is, times the rate of equity plus debt over equity plus debt times the rate of debt. Well, there is, first of all, there is no rate of debt, and because the debt is 0 here, this entire factor goes to 0. So the WACC, when I am 100% equity, is just 100%, or the number 1 times the rate of equity. So what happens to this rate of equity? This rate of equity is calculated from the CAPM. It's a bit of a trick question there, something to keep in mind. You can obviously calculate the whole WACC if you want to, but you're going to end up with zeros on the other side. For the most part, what you need to know is that, for the most part, what we want to focus on is that the WACC has an equity requirement, an equity rate of return requirement inside of it to calculate it, and we're going to use the CAPM, the expected return of the CAPM, to make that calculation.